Bond valuation, what every investor needs to know. Investing can feel like navigating a maze, especially when it comes to bonds, but fear not. Understanding bond valuation is your compass and map. Simply put, bond valuation is the process of determining the fair price to pay for a bond. Think of it like buying a house. You wouldn't pay just any price, would you? You'd carefully consider its location, condition, and potential resale value. Bond valuation is similar. It helps you assess a bond's true worth. Why is this important? Because bonds are more than just pieces of paper. They represent loans you make to governments or corporations. By understanding bond valuation, you can make informed decisions. You can aim for investments that align with your financial goals. So let's embark on this journey together. Let's unravel the mysteries of bond valuation and empower you to make savvy investment choices. The heart of the matter: present value and bond pricing. Imagine lending money to a friend. You wouldn't just hand it over without expecting anything in return, right? You'd want some assurance that you'll get your money back, and preferably with a little extra for your trouble. You'd want your money back plus some interest. Bonds work similarly. When you buy a bond, you're essentially lending money to an issuer, which could be a corporation, a municipality, or even the government. In return, they promise to make regular interest payments, called coupon payments, and repay the bond's face value when it matures. This face value is also known as the bond's principal. Here's where present value comes in. Money received in the future is worth less than money you have today. This concept is crucial in finance. This is due to inflation and the potential to earn interest. Inflation erodes the purchasing power of money over time. Bond valuation takes this into account. It considers the time value of money. It discounts all future cash flows, coupon payments, and principal repayment back to their present value. This process is known as discounting. Summing up these discounted cash flows gives you the bond's fair price. This fair price is what you should be willing to pay for the bond today. Think of it like this. You're calculating how much those future payments are worth to you today. This helps you determine if the bond is a good investment. This understanding of present value is fundamental to grasping bond valuation. Without it, you can't accurately assess the value of a bond. It helps you make sense of the methods we'll explore next. These methods will allow you to evaluate bonds effectively and make informed investment decisions. Yield to maturity. Unlocking a bond's potential. Yield to maturity, or YTM, is like looking into a crystal ball for your bond investment. It provides a comprehensive view of what you can expect in terms of returns. It tells you the total return you can expect if you hold the bond until it matures. This includes all the interest payments you will receive over the life of the bond. Imagine YTM as the annual interest rate that equates the present value of all future cash flows to the bond's current market price. This means it balances out the bond's price today with all the money you will get back in the future. In simpler terms, it's the rate of return you'll earn by receiving those coupon payments and the principal back at maturity. It's a way to measure the profitability of your bond investment. Let's say you buy a bond with a $1,000 face value, a 5% coupon rate, and 5 years until maturity. This means you will receive $50 each year as interest. If the bond's current market price is $950, the YTM would be the rate that makes all those future cash flows. The $50 annual coupon payments and the $1,000 principal repayment, equal to $950 today. This calculation helps you understand the true value of your investment. A higher YTM generally indicates a potentially more attractive investment, assuming the issuer's creditworthiness remains constant. It suggests that you might get a better return compared to other bonds. However, remember that YTM is just one piece of the puzzle. It's important to look at the bigger picture when evaluating bonds. It's crucial to consider other factors like credit risk and interest rate movements. These elements can significantly impact the actual returns you will receive from your bond investment. Always do thorough research and consider all variables before making a decision. The current yield. A snapshot of your investment. While YTM provides a long-term perspective, current yield offers a quick snapshot of your bond's return at this moment. It's like checking your speedometer to see how fast you're going right now. Current yield is calculated by dividing the bond's annual coupon payment by its current market price. For example, If a bond has a $1,000 face value and a 5% coupon rate, its annual coupon payment would be $50. If the bond's current market price is $950, its current yield would be 5.26%, $50 divided by $950. Unlike YTM, current yield doesn't consider the bond's face value at maturity. It focuses solely on the income generated by the coupon payments relative to the current price. While current yield is a useful metric, remember that it's just a snapshot. It doesn't account for potential capital gains or losses if you hold the bond until maturity or sell it before. Section 5. Yield to call, navigating early redemption. Imagine lending money to a friend, but they have the option to repay you earlier than promised. That's similar to what happens with callable bonds. A callable bond gives the issuer the right to redeem the bond before its maturity date. This is advantageous for issuers if interest rates fall, as they can refinance their debt at a lower cost. Yield to call, or YTC, comes into play with callable bonds. It calculates the potential return if the bond is called on the earliest possible date. It's similar to YTM but considers the call date and any call premium, the price the issuer pays to redeem the bond early. Let's say a bond has a YTM of 5% but a YTC of 6%. This means if the bond is called early, your potential return could be higher. However, it also comes with the risk of reinvesting the proceeds at potentially lower interest rates. Section 6.0. Coupon bonds, simplicity in action. Imagine buying a bond that doesn't pay any interest. Sounds strange, right? That's the world of zero coupon bonds. Instead of receiving regular coupon payments, investors purchase zero coupon bonds at a significant discount to their face value. The difference between the purchase price and the face value represents the investor's return. Let's say you buy a zero coupon bond for $900 with a face value of $1,000 maturing in 10 years. At maturity, you'll receive the full $1,000, making a $100 profit. The beauty of zero coupon bonds lies in their simplicity. You know the exact return you'll receive at maturity. However, keep in mind that you won't receive any cash flow until the bond matures. Section 7. The bond market seesaw, factors affecting value. The bond market is like a giant seesaw with various factors influencing bond prices. These factors can push prices up or down, creating a dynamic and often unpredictable environment. Understanding these factors can help you anticipate market movements and make informed investment decisions. By staying informed, you can better navigate the complexities of the bond market. Interest rates. As interest rates rise, bond prices tend to fall, and vice versa. This inverse relationship is fundamental to bond investing. This is because investors seek higher returns when interest rates increase, making existing bonds less attractive. Conversely, when interest rates fall, existing bonds with higher rates become more valuable. Credit quality. Bonds issued by entities with high credit ratings are generally considered safer investments. These bonds are less likely to default, providing a more secure option for conservative investors. Their prices tend to be higher than those of lower-rated bonds, which carry a greater risk of default. Investors demand higher yields for taking on additional risk with lower-rated bonds. Time to maturity. Generally, the longer the time to maturity, the more sensitive a bond's price is to interest rate changes. Long-term bonds are more exposed to fluctuations in interest rates over time. This is because investors are exposed to interest rate risk for a longer period. Short-term bonds, on the other hand, are less affected by interest rate changes. Embedded options. Bonds with embedded options such as call provisions or convertibility features can affect their prices. These features add complexity to the bond's valuation. These options provide issuers or investors with certain rights, influencing the bond's value. For example, a callable bond can be redeemed by the issuer before its maturity date, affecting its price. By carefully considering these factors, you can better understand why bond prices fluctuate and make more informed investment choices. A well-rounded understanding of these elements can enhance your investment strategy and help you achieve your financial goals. Section 8. Bond valuation, your key to smart investing. As we conclude our journey into the world of bond valuation, remember that knowledge is power. By grasping the concepts we've discussed, you hold the key to making smart investment decisions. Whether you're considering individual bonds or bond funds, Understanding bond valuation empowers you to assess the fair price of a bond, compare different bond investments, and make informed decisions based on your investment goals and risk tolerance. Remember, bond valuation is not a one-time event. It's an ongoing process that requires staying informed about market conditions and individual bond characteristics. By embracing the principles of bond valuation, you can navigate the complexities of the bond market with confidence.